Hey, how's it going, everyone? My name is Derek Afasi. I'm the owner of Afasi Financial Group and RetireSharp.com. Today's topic, I want to discuss with you what is a 401k annuity and go over the different pros and cons regarding an annuity strategy that you could leverage through a 401k, a rollover into an IRA annuity, and then also in more recent years, a lot of 401k providers and a lot of 401k plans, in order to solve that problem of individuals outliving their retirement dollars, they're offering these types of annuity provisions that allow individuals to essentially surrender their cash value within their 401k account, utilize that insurance company that might be housing the 401k account to produce a either single life payment annuity on a single life only per individual, or a joint life payout, kind of like how a pension plan works. So I'm going to go over the pros and cons off of where an annuity might be beneficial for a situation, where a 401k is going to be more beneficial, and then if you're offered this annuity provision within your 401k, whether or not that makes sense to go and trigger that specific option. So first off, what is a 401k, and then what is an annuity, and then how do annuities work in conjunction with 401k accounts? And then how can you leverage 401k accounts to do rollovers into specifically designed IRA annuity contracts that might give you a better position or might give you a better solution to what you're trying to accomplish throughout retirement. Now, a 401k is an employer-sponsored retirement plan, and I want you to think of that like in the terms of a bucket. So what's happening is an individual is working for a private institution. If they were working for a state or nonprofit organization, they might be offered something known as a 403b. If they were working for the federal government, they might be offered a thrift savings plan, or municipality might be offered a 457 plan. It's all going to be relative, and a lot of those types of qualified employer-sponsored retirement plans have this type of annuity provision built within those plans when the individual is nearing their retirement years or right before they're going to retire. So with the 401k plan, an individual is working for a company. Let's say that this person's making $100,000 in a given year. That's their salary that they're getting paid each and every year, broken down into weekly, monthly, whatever the case might be. What happens is when this person starts working for the company, they're going to be given their health insurance, their life insurance, different ancillary products, and then also an opportunity to place dollars aside for their retirement, known as a 401k plan. So depending upon how much they make, they could go and take a portion of their salary, have that come out on a paycheck basis or a monthly basis, or even at the end of the year, and take X amount of dollars from their salary that they feel is necessary for savings and invest that into their 401k bucket. So this bucket is going to grow by a combination of two different factors. The first thing are the contributions that you place into this bucket. And the second thing is the rate of return that's going to also further grow within this bucket. So if somebody does not contribute at all to their 401k plan, well, then they're not going to have anything in their 401k plan. If, let's say, they're going and they're contributing, 5% of their salary, and this person's making $100,000, well, that says $5,000 is going to be a contribution for that year into the bucket. If they keep doing that, and let's say that they tied their 401k funds to a fixed account, well, we know that as long as they're putting those dollars aside, it's going to grow by whatever they're contributing into that type of plan. So a 401k bucket has both those contributions, and then they also have something known as a rate of return that could grow that bucket or decrease that bucket at the end of the day, at the end of the year. This rate of return is based upon the different funding options or the different investments that are available to individuals contributing to their 401k account. So on average, it's going to be anywhere between 5 to 25 different options to choose. Majority of them are tied to mutual fund related accounts. So they might have like an aggressive portfolio that's tied to the stock market, a combination of stocks and bonds with different mutual funds, maybe a moderate portfolio, maybe you might have something known as target date funds, different things that an individual could go and allocate percentages of their dollars or percentages of their accounts to say, okay, we're going to throw 25% into a Fidelity Contra fund, we're going to throw another 25% into a PIMCO total bond fund. We're going to throw another 25% into an aggressive portfolio, whatever that is, and then another 25% maybe into a type of fixed account. So this is their diversification that they're hoping that as long as the markets are doing well, or this allocation is going to be performing positively, well, then it's going to return back a positive rate of return on top of the contributions that are going there. So a case in point would be from like the 1980s through 2000. We saw the largest growth into the stock market. There's over a 1,000% growth into the market. So individuals that were investing their dollars in their 401k accounts and they were investing those aggressively were able to at least capture a lot of those positive impacts that the stock market provided. So they were getting, they were obviously their accounts were growing by the contributions, and that rate of return was positive. So they had the power of compound interest working in a positive direction. Well, unfortunately, when you had the little hiccups in the market, the different bubbles bursting, the tech bubble bursting in 01, you had obviously the Great Recession over in 2008. This made investing very realistic, that not everything's guaranteed to go up, and individuals really have to segment a specific plan to prevent any sort of downward market disasters. What I mean by that is you had individuals that had $1 million in their 401k account walking into 08, and they walked out of 08 with 700,000. You had individuals that walked into 08 with 400 grand, walked out of 08 with $200,000. Very large losses that had a significant impact on when that individual was able to retire, and if they were already retired, had a very significant impact, because now they were pulling monies from that account, and that account dropped down, and they were still paying different 401k related fees. So instead of the compound interest working in a positive direction, that compound interest went against their accounts and liquidated their accounts very, very quickly. That's obviously a problem. So when you have annuity contracts, what exactly is an annuity contract, or what's a type of annuity account? An annuity is the opposite of life insurance, where life insurance protects an individual from dying too soon, protects the beneficiaries and the family of that individual dying too soon, paying out a lump sum to those beneficiaries. An annuity protects an individual from living too long. So they have subsequent payments that are getting paid out for however long that individual lives. Why is that important? It's important because, let's say if you had a bucket of money, if somebody had $100,000 in cash, and they decide, okay, I want to retire, I'm currently age 60, and I need to pull out $10,000 of income every single year to the day that I pass away. Well, if they pull out $10,000 and it was in a cash bucket, well, we understand that this person would outlive their money by age 70. They would have no more money left because they would have siphoned through this bucket $10,000, and therefore after that 10th year, there's nothing there left to pull from. So an annuity contract could be, you're basically leveraging an insurance company, you're leveraging their actuarial data, their mortality tables, to say, okay, I have $100,000, let me purchase an annuity contract, and this is just a hypothetical example, but let's say we have that same 60-year-old, and let's call him male, age 60, and they say I have $100,000, they go to an insurance company, and the insurance company might say, okay, we're going to pay you $10,000 to the day that you pass away. So what this says is if this person lives past that 10-year mark, for this really easy math, well, then every year that they live past that age 70, they're now dipping into the insurance company's pockets of pure profit of $10,000, $10,000, $10,000, because they would have surrendered $100,000 to the insurance company, and the insurance company would have given them a contractual agreement, a contractual guarantee that says, yes, we'll pay you $10,000 every single year until the day you die. So if this person passes away at age 90, he would have given a lump sum of $100,000 and received $300,000 back from the insurance company. That was obviously a good move for the individual. Let's say if this person went and started pulling out those monies, let's say he passed away after 2 years, well, they would have paid $10,000, $10,000, $20,000 would have been paid to that individual, and now $80,000 was left over to the insurance company, and now the insurance company made an $80,000 profit. So therefore, the insurance company would have won it in that scenario. If you understand that concept, those are the very basic components of how an annuity works. So individuals have been frustrated because essentially their entire retirement livelihood is all based in their own hands. You know, they were 401k related accounts first came out in 1978 after there was a rule passed, branch of the government known as ERISA that was created in 1974. And what it did was it took the risk from the employer creating a set defined benefit retirement plan known as a pension plan for individuals that say you're going to work for a company for 20, 30 years. After you're done working for the sufficed X amount of years of service, when you retire, you're going to be receiving payments every single month to the day that you pass away or you and your spouse pass away. So that's something known as a pension plan. It's something known as a defined benefit plan because employers would define exactly what that benefit is. Pension plans are still around. It's very rare today, but they are still in existence. So when ERISA was created and you had the implementation of 401k accounts, what it did was it allowed individuals to control their own retirement. It took the risk off of the employer's books, threw it on the employee and said, hey, listen, we have a type of retirement bucket that you could invest your dollars into. You could take portions of your salary, invest that into a type of retirement bucket, and then try to get a high rate of return with your contributions and the rate of return, grow this bucket, and then when it hits retirement age, it's all on you. You have to figure out how to invest this even in your retirement years, make sure that you're triggering income and making sure that you're not running your well dry. So that's obviously a problem. So a couple of years back, you had a lot of 401k providers that they started implementing annuity provisions in their 401k plans, and they're saying, okay, well, you have lump sum in this 401k. What we can do is we can allow you to roll those monies out over into an IRA, which is just essentially kicking the can down the road. If you were just in a 401k that was mainly tied to, mutual funds, and you went and you rolled your money over into an IRA that was just tied to mutual funds, well, you still have that reverse dollar cost averaging risk of paying different mutual fund related fees, falling victim to downward market loss potential, falling victim to outliving your income, pulling out income and outliving your monies. So this implementation of annuities is saying you could go and surrender the lump sum dollar amounts in your 401k account and utilize an annuity contract that's being offered by your plan provider to give you lifetime income. So it's kind of like taking that concept of a pension, but utilizing the annuity provision within that 401k. So it's not truly a pension plan because it wasn't set up through the employer, but they allow that individual to have that payment stream that an annuity allows. Now that's important is because let's say if somebody has $500,000 in their 401k account and they're offered this annuity provision, maybe that company will provide them, $30,000 of income to the day that that person passes away. So it kind of acts like a type of personal pension plan. They surrendered that $500,000. They're receiving $30,000 every single year to the day that they pass away. Which sounds fine. Obviously, they're not going to outlive their retirement monies by utilizing that. The downside to it is what happens if they only live for a couple of years. Let's say they pass away after 2 years. Well, now that person's beneficiaries, they've accumulated those monies. They've taken on all the risk. They've tried all the different strategies to increase that rate of return. And right when it came time for retirement, they took that full $500,000, they surrendered it over to the insurance company, and that insurance company is now providing them $30,000. Let's say, God forbid, they live for those 2 years. They got $30,000 the first year, $30,000 the second year, and then they passed away. That means they would have only received back $60,000 off of providing $500,000 to the insurance company, and now this insurance company walks away with a $440,000 profit. So that's obviously the bad thing, and this is a lot of bad press about annuities, and this is what I think is justified because those are types of traditional annuities. They're known as immediate annuities or deferred income annuities, where you are annuitizing your money, meaning you're surrendering control to the insurance company. A really quick solution to this type of avenue, if you're offered an annuity through your 401k plan, please understand that that is only one offer. If you're in a typical state, you have over 1,200 contracts available, over 1,200 different annuity offers that you can utilize by leveraging an IRA annuity. So let's say in that example, if you went and you took the annuity offer through your 401k provider, they might provide you $30,000 of lifetime income. Or you could go through the top 3 offers in your particular state. Maybe option 1 or company A might give you for that same $500,000. If you went a 401k rollover into an IRA annuity, they might provide you $45,000. Maybe company B is going to provide you $42,000. Maybe company C is going to provide you $47,000. Something that is much larger of a benefit makes much more mathematical sense than being pigeonholed into the crappy annuity contract that is just through that one offer. So, please understand, this is usually the case is whenever individuals are looking to go and trigger their annuity options through their 401k, majority of times it's a really crappy offer, but individuals do not know that they were eligible to go and take the 401k, roll that over into specifically designed IRA annuity, and make sure that they are getting the best bang for their buck, if that is one of their major goals. What we like to try to always educate individuals on is give them the most flexibility, give them the most options available, the most options possible. And we break it down into 3 different segments. And I talk about this on a lot of my videos. I said there's 3 things that every individual needs to figure out before they're retired, or if they're currently retired, how to stay retired forever. So let's say if this person went and they were working for a company at 30 years of age, and let's say they were working there for the next 35 years, they're age 65 currently. Let's say that they have $500,000 that's currently sitting in their 401k account, just like that other example. And now they say, okay, I want to retire. I want to trigger, I want to utilize Medicare. I want to trigger my Social Security income. And I want to leverage a portion of my $500,000. I don't know if it makes sense to trigger my annuity within my 401k account and surrender all those monies. Should I just go and roll that money over into all that money into an IRA annuity, 100%? Or should I go and try to splice these dollars into specifically designed IRA contracts to make sure it's sufficing to the decimal point what my goal is? Obviously, we recommend the latter. We want to make sure that you're having the most amount of control. Annuities are good for the correct situation and they're complete shit for the wrong situation. What I mean by that is the first thing that you have to make sure is covered for pure retirement confidence are your income sources. If this individual is age 65 and let's say they have expenses, we want to figure out what their expenses are and what their income sources are. So at age 65, maybe they have expenses of $50,000. That they have to make sure is coming to them. They have to make sure at least $50,000 is coming to them of income every single year to the day they pass away. Well, maybe Social Security income is going to be $30,000 that they could trigger at age 65. Well, then that tells us is that from that first day, right when they want to retire, they have a $20,000 gap there. Out of this $500,000, they could go place the smallest amount of dollars out of that $500,000, place that into a specifically designed IRA annuity contract that will produce them $20,000. So maybe out of this $500,000, it's going to cost them $300,000. So now what did they do? They didn't have to surrender the full $500,000, leave that into the insurance company's hands and lose full control. There's different types of annuity contracts out there. The ones that we recommend are ones with income rider, so it allows you to have control of your dollars at all times, be able to allow you to leave your cash value, leave your account value to your beneficiaries if you pass away too soon, but still leverage the insurance company to provide you that $20,000 of income. And that $20,000 of income is going to go to you for the rest of your life, regardless if you ran that well dry. Kind of like that other situation when I was saying where the individual wins. So we always want to make sure we're trying to set up plans that get into the company's pockets that much faster, as fast as possible. So now you're receiving pure profit of $20,000 each and every year. So what this tells us is now we have $200,000 left over in that 401k that we didn't need to use. Income sources are covered. They have the lifetime income from obviously the Social Security income that's coming to them, and then they have the other $20,000 of the annuity income that's coming to them. Step number 2 is emergency funds. I apologize for my sloppy handwriting. I know I get a lot of comments on how sloppy my handwriting is. Guys, I get it. The overall concept of these videos is to obviously educate you guys. It's not to, draw a perfect picture on the screen. So please just bear with me on that. But the emergency funds is obviously step number 2. So rule of thumb is you want to have in between 6 to 12 months of money in liquid cash that you could pull from in case of an oh my gosh moment, in case of a medical ailment, in case of a tree coming and falling through your car or on your roof or whatever that case may be, whatever sort of emergency. So if we understand this person needs $50,000 in a given year or of expenses in a year, so maybe we leave $50,000 out of this $200,000 into an IRA money market account. That's just really liquid cash, purely liquid cash. You're not trying to get good growth. You're not trying to have losses. It's just essentially like a cash bucket that's sitting there. So this is obviously the annuity IRA is IRA number 1. This emergency fund IRA is IRA number 2. And then you have the very last stage is inflationary protection. And this could be done in a couple different ways. You could utilize an annuity laddering strategy where you're having step-ups of income. So what do I mean by inflationary protection? Well, at age 65, if we understand that this person needs $50,000 of expenses at age 65, probably around age 67, he's going to need about $52,000. Maybe at age 69, he's going to need $53,000 of income to come to him because some of his expenses are going to be inflationary expenses. Some are going to be fixed expenses. So like the gallon of gas, the gallon of milk, different things. Prices are obviously going to be increasing. So to try to combat that inflationary risk or that purchasing power risk, we want to have these small step-ups of this person's income. So they could utilize that by triggering different deferred, they're known as hybrid annuities, and we just defer them out, 3 years, 2 years, 5 years, 7 years, and all these small increments to make sure that they are sufficing exactly what that inflationary need is each and every year. Or they can now use these other monies, this remaining $150,000, and go into a managed money type portfolio, something that maybe they could utilize passive investment strategies through like Vanguard funds, or they could go and leverage, different fiduciaries and fee-based planners to make sure that they are growing those dollars the best possible way in a combination of stocks, bonds, commodities, real estate, whatever that case may be. So this third avenue is really flexible on how to combat that inflationary protection. But what did we do in a perfect scenario? Let's say that we just put that into a regular IRA, a regular IRA with different sorts of investments and allocated those properly. Well, now we have 3 different IRA contracts. You're utilizing your annuity portion the correct way. You're not throwing too much money into the annuity. You have your portion set up into the money market IRA, and now you're able to invest those dollars and have that additional monies to grow and not really have to touch unless obviously that inflation is increasing and increasing. So this is how you put together an overall plan. You take a very simple solution of saying, I'm nearing retirement, or I'm currently retired. How do I make sure I'm choosing the best option or the best opportunity to leverage specific types of insurance related accounts like annuities, or maybe an annuity might not be necessary at all, and just making sure that you have your safety net set up properly, and making sure that you have that pure retirement confidence that is going to eliminate that reverse dollar cost averaging effect of paying fees, paying advisor fees, falling susceptible to downward market losses, essentially running your well dry, running out of money when you need it most in retirement in your 70s and your 80s. And that's unfortunately what a lot of baby boomers are now starting to experience, is they're not having plans, and they're essentially shooting from the hip and saying, oh, well, I grew my 401k account, for all these years, so therefore I could, figure out how to set up preservation and distribution planning. And it's an entirely different ballgame. Accumulation and versus preservation and distribution is entirely different. So what we try to do is look at the 30,000-foot view off of what your current situation is, see where you are, see what your goals are. Can you accomplish them successfully by just sticking with your strategy currently, or are there slight tweaks that you have to make sure that you're segmenting them into specific lanes into an overall perfect puzzle piece? So if you found value in this video, feel free to give our 1-800 number a call. It's 1-800-566-1002. We're available 24 hours a day, 7 days a week. And you essentially, when you call over to our assistants, you tell them that you saw a video online about a 401k annuity and you had some questions regarding your specific situation. And they're going to patch you over to a specialist. A really easy and efficient way to actually set up an appointment to make sure we're giving you the best possible specialist for that area is to go through our website. And our website is retiresharp.com or fosseyfinancial.com. They bring you both to the same exact spot. And what's going to happen is on the bottom right-hand side, you're going to see a little schedule your phone meeting is going to be able to pop up and allow you to book your strategy session directly with us. So you could see our appointment schedule, or you could set it up for a more convenient time, and then we'll make sure that somebody is available to take your phone call at that time and try to help you out best way possible. But after you're dealing with a specialist, they're going to ask you a slew of questions, try to figure out your situation, and then we try to educate first and foremost through literature pieces, personalized videos, just different virtual conversations, different things to make sure you're comfortable if we did find solutions, how to move forward so that you're as confident as possible. And we are A+ rated on the Better Business Bureau. We've always had very good reviews. We've never had any complaints. I believe it's because of this methodical process. I want to thank you very much for watching this video, and please feel free to subscribe to our YouTube channel, Retire Sharp, so you could have access to the most updated videos. Thanks so much, guys.